I thought what I'd cover today is just give you an update on the journey we've been on over the last really 14 years since 2000, because I do think it's quite an interesting case study in the sort of Harvard Business School mode about how you take a company and you turn it into something far more valuable than it was. So as was mentioned, we have a market cap of about $36 billion now, an enterprise value of about $45 billion. $22 billion of sales in 13, and I'll comment on how we've gotten to this point, but we're now over 60% an electrical company, and that is a very marked change from the Eaton of 2000. 14% hydraulics, 8% aerospace, 17% vehicle, and importantly, we're about 50% U.S. and 50% non-U.S. with a very big emerging markets presence. Customers in more than 175 countries, and the last point I'd just note on this slide is that we are now headquartered in Dublin, Ireland. Today, Eaton is a leader in global power management, whether it be electrical power, whether it be fluid power, whether it be mechanical power. We can handle all of the power needs of business, and we combine those powers in ways that we believe creates better solutions for our customers. And as you'll see, our journey over the last 14, 15 years has been really to start from that vehicle base and turn ourselves into a very different mix of business. And the reason we've done that is that as we, in fact, let me go to that next, as you look at Eaton, as you look at what Eaton was in 2000, we were about 80% a company in the United States, and we were a company that had almost half our sales in the vehicle space, and in fact, the majority of our profits were in the vehicle space. And as we looked at that space, we said, you know, there are certain characteristics that we think over time will not create as much value as we might. And as we looked at this mix, we said, you know, this is not a mix that over the long term is going to reach the objectives that we as a management team have. And so we embarked on a program to change the mix of the company. That led us to say, you know, we really have to change the mix of the business. And we need to focus on businesses that have higher growth, have a better value proposition, hence better margins, and have lower capital intensity. That'll create a model that creates a lot more economic wealth and is a lot more sustainable. Well, the only way you're going to change the mix of a business for a company that even in 2000 was a pretty large company and $6 to $7 billion in size is you're going to have to do a lot of acquisitions and some divestitures. So that's what we embarked upon, and since 2000 we've done 65 acquisitions. We've acquired annual revenue of $12 billion, and we've invested almost $20 billion in these acquisitions. Now, in order to do this many acquisitions, 65 acquisitions, you've got to have a very disciplined process, and that's indeed what we have, all the way from identification of possible targets, to the way we do due diligence, to the way we negotiate contracts, and the way we price acquisitions, to closing it, and the way we integrate it. In fact, we even have a manual on every stage of that process, and you have to, because acquisitions are a game of details, and if you lose your discipline at any point in that process, you are very likely to not achieve the objectives that you're after. But we didn't do any acquisitions last year, and the reason we didn't is that we closed Cooper in November of 2012. It's the largest transaction we've ever completed. Cooper, in its own right, a very large company, about $6 billion in revenue, 29,000 employees, over 130 manufacturing facilities. We and Cooper had almost no overlapping products. So Cooper was a truly complementary acquisition. So it gave us a much broader product line that we felt we could use ably to provide better solutions to our customers, better opportunities and value to our distribution channels. Indeed, that's what's happened. And I'll go into some depth on the results of the Cooper transaction. The aerospace market, we're a big supplier to Comac, the C919, which is the Chinese entry into the single-aisle market. We're a big supplier to Embraer down in Brazil. We just consolidated our Middle East activity into a brand new Dubai regional headquarters, which we think is important to deal with the growing oil markets in the Middle East. Had some big wins recently in Saudi Arabia, like the Jeddah, Saudi Arabia airport. Actually, I'm headed over there Saturday to help spur some of our growth activities in Saudi Arabia. And expansion of our Jenin engine valve facility. It's actually our single largest automotive engine valve facility in the world. So all of these actions have fundamentally transformed Eaton from its past as largely a domestic U.S. vehicle manufacturer to truly a global power management company, one with a very wide range of capabilities. Well, what have the results been? Because after all, that's really what impelled us to start on this strategy. And I thought I'd just look back over the last decade. It's a time period most people like to use as a marker. And so if you look at just the last decade, our sales have grown on average at 11%, operating EPS at 12%. Our electrical, hydraulic, and aerospace, i.e. the non-vehicle parts of Eaton, have grown 3.6 times. International sales have grown 3.7 times. Our segment margins are up 470 basis points to about 15%, and operating cash flow up 2.6 times to $2.3 billion last year. You know, we really have ramped up the pace of innovation. Thomson Reuters, for example, does an annual survey where they look at the most innovative companies in the world, and for the last 3 years we've been named as one of the 100 most innovative companies in the world. If you look at our patent portfolio, it's a very large number of patents in total, and even last year we added almost 1,000 new patents to our portfolio. If you look at the mix now, I mentioned 61% electrical, so we're very pleased with that mix. By destination, the 50% U.S., 50% non-U.S. Over time, I believe that we'll probably move to where we're probably 60% non-U.S., maybe over time even 65% non-U.S. And, you know, the reason is that the U.S. is only 22% of the world economy, and we sell products that are very foundational, products that really are needed everywhere as long as your economy is, you know, above just a very low level of economic activity. And so, frankly, over time, Eaton's mix of business should come to mirror the world economy pretty closely, if we're successful. Just to understand a bit better how much more consistent we had made the company is we did a little exercise last year where we looked at the performance of our end markets based on the mix we had at the time in the recessions of 80, 90, and 2000 and 2001. Now, we didn't include the Great Recession because it was such an unusual downturn that we thought it really wasn't very representative. Frankly, I very much doubt that in the rest of my business career that I'll see a downturn like the Great Recession. So this looks at what we would call a typical recession, and it looks at what happens in our markets, the peak-to-trough decline. And what you see is that the old Eaton, before we had significantly changed the mix, we would typically find a peak-to-trough decline of about 10% over the course of the recession. The new Eaton, with the new mix that we put together, that decline's only about 4%. So we feel that's some validation of how the mix is going to provide a much more consistent performance throughout economic cycles. And if you look at perhaps the ultimate measure of success, total shareholder return, and this is simply share price appreciation and dividends, and simply reinvesting the dividends when received. Over this time period, we've averaged 15% return each year. 15%, that's, I would argue, an exceptional number, and you compare that to even this enhanced peer set, they were only at 12%, and then, of course, the S&P 500, a laggard at 5%. So we really have created a lot of value, and a way I sometimes turn it into very tangible numbers for people is I say, you know, if you really want to cut through it, if you had $1 of Eaton in 2000 and you just held it at your broker and said, just reinvest those darn dividends and I'm not going to pay any attention to it, and you then woke up last month and said, I wonder what that thing is worth. Well, that dollar would have risen to $6.40. This is the plan that we have. It frankly is not very different than what we've done over the last 14 years. The first thing we're going to do is reinvest in our business, about 3% of sales in the CapEx. Secondly, return cash to shareholders with a growing dividend. And we've grown our dividend on average over the last decade at 14%. We have a dividend yield of about 2.6%, so that's pretty attractive. Third, we're going to retire debt to restore our balance sheet. We did take down $4.9 billion of debt to complete Cooper. We committed to the agencies we would pay down $2.1 billion of that. It's not the same debt, but we would just pare our total debt by $2.1 billion, and we're within about 18 months of completing that. Fourth, to continue to invest in acquisitions as long as we can hit two objectives. One, to further our strategy, and secondly, to earn at least 300 basis points over our cost of capital, because we regard that as the minimum acceptable return as we look at new acquisitions. And the good news is we probably can be back in the market in 2015. And then lastly, we will use share repurchases as a relief valve if we become overcapitalized, which can happen. I mean, in very frothy economic markets, I mean, we won't do many acquisitions because we're not going to overpay. I mean, there's no easier way to create a bad acquisition than to pay too much for it. Or if we have one of those episodes where the market just suddenly drops, and that happens occasionally, we'll go in and buy our stock at a discount. As a CFO, I'm sort of innately cheap, and somebody wants to sell me Eaton shares at a really low price, I'm all there. I'll come in and, we've had individual months where we've popped in about $300 or $400 million of shares, and so we bought actually $1.9 billion over the last 10 years of our stock. So that's our capital allocation plan. I think it's quite shareholder friendly, but I think it also is oriented towards future growth.